Well, good afternoon, listener. This is Jonathan Davis, and it's the very first recording of the new Booms and Busts podcast. It is right now 12:30 on Wednesday, the 8th of February, and I've been away from podcasting since about the end of May last year. Those of you who have found this podcast, some of you will remember that for a few months in the first half of last year, I did the Booms and Busts podcast, and it was really great. I had a blast doing it. It was great fun. And then at the end of May, the guy that I was doing it with, no names, no pack drill, but let's just say he's not an extremely helpful person. I think the word is that he used on me in a recording that I still have of a bullying voicemail that he left me. He is also an irrelevance, as he called me. But enough of him and working from his bedroom. This is the first podcast, Booms and Busts, which I hope to be able to re-establish as a weekly podcast. I've yet to work out the technology, so much so that I did actually record this last Saturday, but believe it or not, the technology didn't work. So I'm having to do it all over again. And then I've got to work out about getting it hosted on the interweb, and then you can download it and listen to it. But it is really fantastic to be back podcasting again. As I say, in the first few weeks, it's going to be a bit haphazard, but I'll get into the swing of it, and I do hope that you'll become a regular listener. 2016 was very interesting. I remember on the very first show that I did last year, in the same week, I moved house and office. So that was pretty hectic at that period. And in investment terms, we had a great year. Now, again, listeners to last year's shows will recall that in February, March, April, I was bearish because, some people might say, well, that's the way you are, JD. Well, no. I was bearish because the economic statistics globally and nationally were absolutely awful. We were seeing, for example, Japanese exports in US dollar terms down double digits, for example. I mean, it was remarkable right across the world. The statistics were absolutely dreadful. And yet, we saw, and I was talking about it for weeks and weeks and weeks, we saw such things as oil rising and rising and rising. We saw gold rising. In other words, we saw commodities rising. And another way of looking at commodities, in essence, is anything that you grow or you take out of the ground. So it might be wheat or a crop, or it might be something you take out of the ground like a metal, like gold or iron, or indeed oil, or a gas, that sort of thing. These are commodities. And of course, when they rise, that's inflationary. So, as we were going through the shows in February, March, April, May last year, we saw on the one hand economic statistics which were absolutely dire. But on the other hand, again, all you have to do is go back and listen to the shows if you've got them downloaded, and you'll hear that I'm saying, but hold on a minute, we're seeing commodity prices rise left, right and centre. And this is inflationary. And going into 2016, clients of Jonathan Davis Wealth Management were very heavily invested in deflationary assets, in other words, government bonds, And in a later show, I'll explain again why government bonds do well when we have deflation. But from about the end of January, February last year, I was already reducing our exposure to government bonds and increasing, as I did so gradually throughout the whole year, I increased my exposure to inflationary assets. Why? Because although the economic statistics were dire. I mean, it was hang yourself time, guys, because, the world is going to hell in the handcart. On the other hand, as I say, we saw inflationary conditions coming in, and sure enough, and I well remember in the early part of last year, talking about he who will not be named, he was interviewing me and asking me about oil, which at that time was about $30 a barrel, and you had bank after economist after economist and pundit after pundit saying, oh, it's going down to $15, it's going to $10 a barrel. And I was saying at $30, seems to me as if it's done most of its worst, if not its worst, because it was $110 a barrel in 2014. It's come down 70%. And, when it gets into the mainstream media, and that includes certain podcasters who think they understand markets and the media, it's so funny, then I know that we're actually getting to the end of the run, in this case, the bear market run. And sure enough, it went down to $26. And you know where we are now? It's doubled. It's about $52. It can still, it can go down into the late 40s, and it's still in a bull market. And so long as it stays above sort of $46 a barrel, which I'm pretty sure it probably will do, all other things being equal, we're probably likely to see 60s or maybe even 70s this year. And that is 200% practically onto the early 16 price. That, of course, is hugely inflationary. And indeed, when you look at the price at the pumps, I've noticed that it's up 25% in a year. Now, of course, that's going to have an effect on the inflationary indices. And when you're in a period of inflation, you want to be invested in inflationary assets. And when you're in a period of deflation, you want to be invested in deflationary assets. And that comes to one of the cores of what this show is about. This show is unashamedly capitalist, free market thinking and discussing. And we hate everything about socialism and cronyism, which of course is what you get in every show that you can think of. I cannot actually think of another show, whether it's on the radio or on the TV, that is free market capitalist. I can't think of one. This may be unique in the United Kingdom. And we're going to talk about capitalist issues compared with the nonsense which is socialism or cronyism. And we're going to point out again and again how bad socialism and cronyism is, not for the elite. Capitalism is bad for the elite. Cronyism and socialism are bad for the elite. Are good for the elite and bad for the people. It's capitalism that is bad for the elite and good for the people. And that has been proven time and time and time again throughout history and geography. And we're also going to talk about portfolio management and what's likely to be good for investing in your pension and your ISA and whatever. And that's why I say last year was a good year for us, because we were heavily in deflationary assets as deflation was becoming manic in the mainstream media in the first half of last year. We gradually moved out of deflationary assets, government bonds, and gradually increased significantly into inflationary assets. And indeed, overall last year, a typical client of ours made about 22% net, which is obviously a really good year. 2017, here we are at the beginning or so of February 2017. We've got the whole year ahead of us. it seems as if it will just continue. We continue in inflation. We see oil, gold, uranium, emerging markets as in Brazil, Russia, India, China, Indonesia, Mexico, etc., continuing to do really well. And they will do because they are largely the countries that take the thing out of the ground or grow the things and then export them. America, McDonald's gets most of its beef, of course, from Brazil. Brazil's a huge oil producer. Russia, huge oil producer, and so on. So the inflation continues. We're at roughly in the UK 2% on the inflation index. I've been saying for months now, when it was 0 months ago, that it's going to go significantly higher. And it's going to go higher still. Do I think it's going to go to 5% this year? I think that would be a surprise. But it's going to continue to rise. And of course, wages will not keep up with it. And that's a really important point. Because when you have inflation, generally speaking, wages don't keep up with inflation. Thus, standard of living falls. That's why deflation is so good for the people, because although your wages don't rise, the cost of living doesn't rise either. The other thing to note about the economy is that by the last third of this year, it's entirely possible that the US could be in recession. Actually, a falling economy. And of course, practically no one's talking about this. And why do I say it? Well, you know, there's a very interesting economic statistics. It's a fact of history. And this, I think, could blow your mind. But since the year 1900, after every 2-term US president, there's been a recession. Every single time. And Obama and Clinton and their cronies in the banks, in the media, in the central banks, you name it, they pulled that elastic further than it would normally go in order to get Clinton elected. It didn't work. So, of course, they've left Trump a massive economic overhang. And Trump's never going to achieve anything in 2017. His talk about $1 trillion, that's $1,000 billion in infrastructure spending, it won't even start till next year. So Trump's not going to do anything for the economy this year. What's going to occur for the economy is already baked in the cake, baked in the oven. Whether it was Clinton or Trump, it wouldn't have mattered. If we're going into recession, we're going into recession. Let me tell you a very hard economic statistic, as opposed to historical fact, as to why we may see the economic peak significantly later this year and why that might lead to recession going into 2018. In fact, a week or two ago, I sent out the Booms and Busts report, which accompanies this show. And indeed, anyone who wants that report can get it. All you have to do is either send me a tweet at Jonathan Davis, where the O is a 0. That's Jonathan Davis, where the O is a 0. Or send me an email at jdavis@jonathandaviswm.com. jdavis@jonathandaviswm.com. And I'll send you it, and I'll put you in the list for future ones. In that, I showed a couple of very interesting charts about jobs numbers in the United States. Why am I talking about the US so much? This is an important point itself. Be under absolutely no illusion. What happens in the US absolutely is important to the Western economy, indeed the global economy. So it's a simple, take it as read. If the US goes into recession, we're going into recession. And the chart was 20 years of jobs numbers. And it showed very clearly that jobs numbers actually peaked months only before the 2000 dot-com bust. Jobs numbers peaked about a year, maybe a year and a half before the biggest economic and financial collapse in history in 2008. And you know what, folks? Jobs numbers looked as if they've peaked in the last few months. Again, this is Obama and the cronies pulling that elastic band tighter than realistically it should have gone. And, you know, they talk about how great the jobs numbers are and all the rest of it, and this is the same in the UK and so on. What they don't say is that there's a massive rise in self-employed, earning much less than they used to when they were actively employed with big companies. And there's, of course, a massive rise in part-time work. And there's also a massive rise in low-paid service non-skilled jobs. So, you know, the majority of jobs that have been taken into the economy recently in the last couple of years haven't been big earning jobs. They've been low pay. So, you know, this, of course, is going to affect negatively the economy. And that's where we are with regards to 2017. So in terms of investing, stay with the inflationary cycle, which may actually only last until, say, the end of the summer into the autumn, because at this stage, there's a 50-50 that we could see the economic peak of the cycle, which of course started in 2009, post the crash of late 2007 to early 2009. So we've had, by next month, we'll have 8 years of an economic cycle. I can tell you, it's long in the tooth. It's very long in the tooth. And on top of that, it follows a 2-term president. And talking about the presidential election, the two absolutely biggest political explosions of 2016 were, of course, the wonderful Brexit and the astonishing election of Donald J. Trump. Now, I want to disabuse you of a myth which the mainstream media, every economist, every marketer, market pundit want you to believe. That Brexit caused the downfall of the pound sterling. It's such a lie, you couldn't believe it. Am I saying that the pound didn't fall on the day after the referendum on the 23rd of June? No, I'm not saying that. So, JD, what on earth are you talking about? You can't be contradictory. I'm not being contradictory. All that was, that fall on the 24th of June 2016, and for the next few weeks, all it was a continuation of the trend. The pound's been falling for years. Depends how you look at it. You can either say the pound's been falling since 1914, when we went into World War I, we had to borrow massively to pay that. And we ended the British Empire. And that was when the pound was at its peak. Okay, we might not want to go back 103 years. Fine, let's go back to 2007, which is, of course, 10 years. October 2007, less than 10 years ago, you could get $2.10 for a pound. By 2014, the summer, it was $1.70. And now it's about $1.25. In other words, it's a continuing trend. And of course it is, because the pound is a dreadful currency to own by global finance. Why? Because as I said often enough in the podcast last year, the Britain has the largest twin deficits in the developed world. Now, what does that mean? The first huge deficit we have, in my day, they used to call it the public sector borrowing requirement. It's the deficit. It's the borrowings that the government has as a percentage of the size of the economy. And our deficit, as the size of our economy, is huge. The second deficit is simply the fact that we import vastly more than we export. The balance of payments deficit. So if you have the largest twin deficits in the developed world, nobody in global finance is going to love your currency. So that's the reason, that's the very simple reason why the pound has been falling, well, either for years or decades, depending on your point of view. And it has nothing to do with Brexit. Similarly, we haven't yet even initiated Article 50. So this nonsense that Brexit would do good for the economy or do bad for the economy was exactly that. Just nonsense. It may start doing stuff in a couple of years' time when we actually Brexit. Oh my God, do you know what? On the morning of the 24th of June 2016, I tweeted a photo of myself and my wife. We were drinking champagne. I was absolutely elated. I couldn't believe it. It was one of the most pleasant surprises of my life. It was and is fantastic. But of course, within 24 hours, I started having doubts. Are we actually going to Brexit? Well, all I can say is I have no doubts now. And it's going to be a quality Brexit as opposed to a pretend Brexit. I don't know if you heard Theresa May and her 12 points that she made in her speech a few weeks ago, but it was an absolutely breathtakingly good speech. And I would put it up there, actually, with anything as good as Margaret Thatcher said. No question about that. Of course, it doesn't get to the heart of the problem, which is the banking system, but there's no question we will Brexit, and we will Brexit in a great way. And that is fantastic. And, you know, people still argue about whether or not Brexit will be good for the economy or so on. And here I am, an economist and wealth advisor, speaking to you, and I say to you, for me, Brexit has nothing to do with the economy in the sense that we can't forecast whether or not it'll be good for the economy. Now, I happen to believe that it will be great for the economy, but it's debatable. But what is not debatable is that we are bringing back democracy to the United Kingdom. We were going down a road where after 802 years since the Magna Carta, we were going to lose 100% of our democracy. I said in a speech, in a debate prior to the 23rd of June, I said that Westminster will become the equivalent of a county council to Brussels. And of course, Brussels is in itself unelected, whereas at the moment, at least, Westminster was always elected. So that would have been absolutely dreadful to lose our democracy. We're bringing back our democracy, guys. That is the most fantastic thing. But Brexit, with regards to the economy, get it out of your head. It's a nonsense. It's also a nonsense that it affected the pound. It also hasn't affected the stock market. The economy, the pound, the stock market, you name it, they were all going to do whatever they were going to do anyway. Similarly, Trump, with exactly the same nonsense. Trump will be great for the economy. Trump will be terrible for the economy. Well, you know, we don't know. We simply don't know. And in any way, in 2017 and probably even 2018, whatever the previous president did is what bakes in what's going to happen. Trump, you know, they say, well, he's going to spend $1,000 trillion on infrastructure. It's not going to start till next year. And in any case, do you know what the size of the US economy is? I'll tell you what. Best of three guesses. Is the US economy $5 trillion? Is it $12 trillion? Is it $19 trillion? It's about $19 trillion. And Trump's talking about $1 trillion over 4 years. $19 trillion a year for 4 years is, of course, $76 trillion. We're talking about a difference of 1 out of 76. Trump's not going to make any difference to the US and global economy. In fact, if he's smart, he should actually create a recession starting this year. Why, you may ask? Well, like any chief executive coming into a company, he should make it go into failure mode and say, it's all right, chaps, I got it under control. He should reset his stock options, he'll clear out all the rubbish, and 5 years later, he'll be a hero and he'll retire with £100 million. Similarly with Trump, he should create a recession, clear out all the rubbish, and then get re-elected in 2020. By the by, it doesn't matter. The stock market doesn't care about Trump. Equities, commodities, government bonds, you name it, nothing cares about Trump. What they care about is the global economy. Trump, the one thing that Trump will be fantastic, and he already is, there's no question, absolutely sensational for free speech. The way he uses Twitter and talks directly to the people, and he bypasses the fake news mainstream media, is a sight to behold, and I absolutely, utterly adore him for that. We'll talk more about Trump and Brexit, of course, in the future, but no, in summary, certainly for the first half of this year, expect the inflation to continue. But in the second half of this year, I wouldn't be at all surprised if we see deflationary conditions come back and indeed possible recession. In terms of specific investments, well, I'll tell you what, in October of last year, we went heavily into gold and gold mining shares. Let me give you a brief history of gold. Around 2000, 2001, gold bottomed after a couple of decades of a bear market at about $250, $300 an ounce. And by 10 years later, 2011, gold was over $1,900 an ounce. In other words, it had gone up 500 or 600%, and gold mining shares had gone up 1,000% in those 10 years. From 2011 to January 2016, gold, silver, gold mining, you name it, big crash. Oil, big crash. Commodities generally, big crash. Gold went down from some $1,920 an ounce to $1,050 an ounce by January last year. The sentiment against gold and precious metals was so overwhelmingly bearish. And listeners of my shows in the first half of last year will remember how bullish I was on gold, and particularly gold mining shares. And indeed, from the middle of January to the end of August last year, in just, 7.5 months, the gold mining shares fund that we invested in went up 220%. Absolutely sensational. After such a breathtaking run, while gold went up 30% or so, going into September, October, prices fell quite markedly. They continued falling in November into the middle of December. In October, we increased our exposure markedly. It's now our biggest holding in our portfolios, and for the last 6-7 weeks, and that includes Christmas, of course, gold, silver, mining have been up leaps and bounds. small gold mining shares are up 30 or 40%. And this bull market is really back in force, and it's likely to continue well into the summer. And I wouldn't be surprised if gold mining shares ultimately, from the low of the middle of December, by the summer, go up 100 or 150%. And that would be absolutely brilliant, and I think that's what's likely to happen. So, I've been talking, I guess, for 45 minutes or so. I just want to say it's been absolutely fantastic to be making this podcast again. I hope you enjoy it. I hope you enjoyed the podcast I did last year. Let me tell you a little story about he who will not be named. When he and I parted company, he did something which I found absolutely breathtaking. He deleted from the system, from the internet, all of my podcasts without first telling me he was going to do so I wasn't able to get my podcasts. Can you believe that? This is what this kind of person does. However, I'm in control now. I've got everything under my auspices, so that's of course never going to happen again. What I have to find out now in more detail is how I get this into a hosting company, hosting of podcasts, and then we put it onto the internet. It may be a week or two before we get this onto the internet, but as of the 8th of February, this is this podcast. As you might remember, my format of my shows where I'd talk about economics, I'd talk about markets, I'd have a live interview with a market participant or a pundit, and then we'd talk more about politics and economics. And we also had the quote of the day. Whether or not I'll have the exact same format as I did last year, I'm not sure. It'll be a bit of an iterative process. I'm learning as I go along, but I'd love to hear your ideas. Tweet me, as I say, at Jonathan Davis with the O as a zero. Email me at jdavis@jonathandaviswm.com. But I certainly will keep quote of the day. And this one, to start off this show, comes from arguably the worst economist ever, John Maynard Keynes. He who created Keynesianism, which basically said governments should all be socialist. Whatever way you look at it, that is essentially what he said. Governments should all be socialist. Well, I don't agree with that, of course. But it's quite a funny quote. In the long run, we're all dead. Listener, I've had an absolute blast. Thank you so much for listening. Please do get in contact. I'd love to hear from you. I will let you know on Twitter when the next show will be. All the very best. Talk to you soon. Bye-bye.